Leading us off is Tim McCusker. NEPC is a global leader in institutional wealth management and consulting with private foundations, endowments, and institutional clients. Tim was named the president of NEPC in January, overseeing the $1.9 trillion in assets that NEPC consults. Prior to that, he was the chief investment officer overseeing NEP's investment research, a global team of investment professionals across multiple disciplines. Tim serves on NEPC's executive and management groups and is a member of the marketable investment, private investment, and asset allocation committees. Tim earned a BA in mathematics from Colgate University and holds a CFA and Chartered Alternative Investment Analyst designations. We are so thrilled to have Tim join us this morning. Please join me in welcoming him to the stage.
Thank you, Margaret, and thank you, everyone, for having me here today. It is my first time in Kansas. I'm very excited about that. I think I've only got 7 states to go now, so another one checked off. Really excited to be here and tell you a little bit about what we see going on in the world. As Margaret mentioned, we are an institutional advisory firm, so we work with large public pensions, like state-level pension plans, corporate pensions and 401k plans, endowments, healthcare systems. So we get a really interesting view of the world in helping to manage these large pool of assets. And it's a really complicated time right now. We have artificial intelligence. We have geopolitical conflict happening in real time. We have a new Fed chair. We have the build out from the Mag 7 of artificial intelligence, the infrastructure that comes with that, and all of these forces coming together to make a really complicated investment environment right now. And what happens? Equity markets just keep going up. So I think that's the most important thing, to just stay long-term focused, stay diversified, and stay balanced in your approach. So I'm going to talk a little bit about what we see happening in real time, then maybe take it out a little bit and take a longer-term view, and hit a few more anecdotal things that we see going on over the next 6 to 9 months as well. So what's happening right now at the Bloomberg Commodity Index? So a very bumpy ride in the first quarter where markets were chugging along, and then all of a sudden we had events in Iran shooting oil prices up. So this is the diversified Bloomberg Commodity Index, so all different kinds of commodities, grains, metals, energy. That was up almost 25%. Oil in particular up 60%. And a flatlining of markets, most of the gains from the first 2 months of the year turning into losses as the market reassessed where we should be with this conflict going on. Now, interesting, mostly from adjustments to valuations. The actual earnings, the actual activity of these companies continued to be really strong and continues to be as we see the earnings season play out so far this year. So the underlying economics continue to drive forward, even with some uncertainty bringing markets down a little bit. And of course, very quickly, as we get to a ceasefire, markets recovered. So these are 4 major equity markets. You've got U.S. large and small cap equities. You've got international developed equities, so Europe, Asia, Australia, and then emerging markets. Lots of peripheral countries that come with that. And you can see about a 10% correction from the top. And this is a couple weeks old now. It's a more than 10% recovery at this point. So the market has fully embraced a ceasefire. And I think even regardless of what happens going forward, has embraced that the market can look past events that are going on there and see kind of that long-term perspective that companies' economics are going to continue to be pretty strong. It looked like we were seeing a lot of weakening in the actual underlying economic activity. And that makes sense when you think about gas prices going up. The average consumer only has so much to spend. If they've got to put more of their money towards filling the gas tank or paying their energy bills, That's less to spend on new things. And so growth gets swapped for inflation. And it looked like the economic results for the first quarter were tracking towards just a little over 1%. Now, this actually came in, the first reading for it came in closer to 2%. I think the big challenge here is how long energy prices stay high. We're seeing the consumer price index come in above 3% now. That's a lagging number. It shows the last 12 months of price increases. This is from the Cleveland Fed, and it gives us more of a real-time measure of where inflation is today, and it looks more like 5%. And that's certainly what it feels like for the average economic participant. And it feels a little bit better in the US than it does in other parts of the world. Asia and Europe are much more acutely impacted by this dramatic increase in energy prices than we are in the US because we produce a lot of our own energy. So we don't feel that same disruption in energy prices, even though prices have gone up. A lot more of it is produced here. So we have a little bit more control of the supply. What does all this inflation mean for markets? First, it means that central banks are probably on pause for a while. We came into the year with an expectation from current levels, that dark blue bar, that the Fed, the ECB, the Bank of England, the Bank of Australia, People's Bank of China would all be cutting rates this year. That we had kind of gotten to a neutral point on inflation. It was down in the 2% range. It finally had that long journey down from those high inflation levels. We got from the high single digits down to about 3, and that journey from 3 back down to 2 on core inflation took a lot longer. We were finally there, and it was going to be time to cut rates. Doesn't look like that's happening now. It's really hard for the Fed to cut into an inflation cycle. I'm sure it's frustrating for the Fed because it's inflation that they can't control. It's an exogenous shock to energy prices. Nonetheless, cutting rates and spurring economic activity in a higher inflation regime would likely only create more inflation. So that's the challenge, I think, for markets now, that there were these expectations of rate cuts, and they don't seem to be happening as expected, at least not right now. There's certainly someone in Washington that's very frustrated by that, and I'm sure he'll be expressing that view at some point, but really hard to cut in this environment. So let's turn to equity markets and see what's going on there. Really hard to have any kind of conversation about stocks and not start it with the Magnificent Seven. This is really unprecedented concentration in U.S. equity portfolios. When we look at these Magnificent Seven companies, you're probably familiar with all of them, these big tech companies, Meta, formerly Facebook, Microsoft, NVIDIA, making all of the chips that go into these AI data centers, Alphabet, formerly Google, Amazon, Apple, Tesla, collectively mid-teen trillions of dollars of market capitalization. So it's not that long ago, a decade, a little bit more ago, that we saw our first trillion-dollar company. We now have $4 trillion companies in NVIDIA and Apple, tracking towards $5 trillion. So these are driving results for the U.S., for better or worse. Right now, that's been a little bit worse. For the last year and into this year, the S&P 493 or the S&P X, those Magnificent Seven companies, have actually outperformed the Magnificent Seven just by a little bit, but that's true in 2025 as well. So we are starting to see some broadening of performance, even as the Magnificent Seven continues to deliver and do quite well. And we'd hope that this continues. I think it's a good thing for markets to not have as much concentration. It's a good thing for active managers to see more differentiation across those 500 companies, rather than just betting on the Magnificent Seven and seeing it continue to outperform everything else. Now, that said, when we look at what's happening at these companies, they are continuing to do really, really well. I think there's always the question, when you see I go back one. Whenever you see a chart that goes like this, it looks like a hockey stick. I think all of our instincts are that that has to be a bubble, right? All that money chasing something has to be a bubble there. When you look underneath, I think this is very different from what we typically see in a bubble. Usually in a bubble, you see valuations running away, getting into the 30s, the 40s, the hundreds sometimes. You start hearing people talk about multiples relative to revenues, not relative to earnings. The multiples on these companies are high. They're in the high 20s and low 30s, except for Tesla, which is kind of insane. But they're justified by the growth levels and the earnings that these companies produce. They are consistently beating those expectations, consistently delivering higher and higher. And the other thing that these companies are doing, they are spending just unprecedented levels of capital. They are taking capital expenditures and investing in data centers. They are in a race against one another to build out their AI capabilities, build out their computing power, and trying to win on each of their models so that they can be the providers of AI solutions and get positive ROI. Is that we can't keep up with it. This is a chart from the beginning of the year, and it's over 500 billion of expected spending from those 7 companies over the course of 2026. They have already come out several times over the course of this year and up those numbers, and the run rate now is over 700 billion of spending. And that has real implications if we go back to that GDP number that was tracking down towards 1%. This is a full percentage point of economic growth for the United States. So this is a shock absorber for growth. Even as we feel inflation from the geopolitical conflict, we have this spending that's happening. Now, it's happening in a pretty concentrated way. Data centers aren't getting built everywhere. They're getting built in lots of places, but it's more concentrated where that's happening. So there's a regional element to it. There's also a sector element to it. There's tech companies that are big winners, and that NVIDIA in particular. NVIDIA hardly shows up for CapEx spending because they are taking that's revenue for them. It's their chips that they're selling to the other companies here listed. It's construction companies, it's electricians, it's all of the horsepower that has to go into building out these data centers so that they're ready to have compute. It's also power where there may be shortages over it. The other positive that we see in markets right now is a really healthy capital markets activity environment. So this is U.S. corporate bond issuance for investment grade and high yield. And we see it tracking above levels that we've seen in several years. So despite the uncertainty of some geopolitical conflict and midterm elections coming up this year, corporations are saying this is a really good environment for us to be issuing debt, taking capital, and putting it to work. A lot of that is from some of those Magnificent Seven companies levering up. And they just don't, as much as they have a lot of cash on the balance sheet, they do need to borrow to do all the things that they need to do. But more broadly, we're just seeing a pretty healthy environment. And I'll talk about it in a little bit. We do think that that's going to translate to the IPO environment as well, where some of these large private companies are going to go public and broaden out the public equity. So let me turn to one other thing here, a little bit of a shift on credit. So that's the healthy environment for borrowing right now, that corporations are looking to borrow more money. You've probably seen some headlines out there about challenges in private credit. And related maybe to AI, where there's been a narrative out there that AI has become so good that it is going to disrupt the revenue model of some of these software companies. Software generally builds some kind of tool that corporations need. Corporations pay a subscription fee, often per seat, and the long and short of it is that folks now think that, well, you can just go to Claude Code and build your own software model, or build all the things that you would have needed for that software model, and you won't need it anymore. Or you'll be able to negotiate down with the Oracles and Workdays of the world, these really business essential tools will get disrupted because of AI. And we are seeing some cracks in the armor here where default rates are going up in direct lending, which is kind of the broadest part of the private credit world. So you can see in the bar chart that there is a trend moving up above the moving average now. So it's getting to be a little less healthy in credit right now. We do not think that private credit is about to explode and that there's major issues lurking there. One of the reasons why is just the structure of private credit now. So private credit emerged as an asset class over the last 15 years or so because banks used to do that historically, and new bank regulations coming out of the financial crisis in 2008 restricted banks from doing all that lending. There's a reason why banks liked doing that lending. It was short term, it was floating rate, it helped them build longer term relationships with all these corporations. They were really restricted. The capital charges for them doing that became really challenging. And so it started with institutions, clients like ours, stepping in and providing capital where it was needed. So you see, I mentioned that hockey stick chart that you sometimes see that think it's a bubble. If I showed you private credit AUM, that would look like a hockey stick as well. You'd see that tremendous growth. But I think what's lost there is that a lot of that capital coming in was replacing the capital of banks historically. So we've had some headline defaults in the last year or so. First Brands, maybe a name that you saw show up in the headlines. And there was some fraud involved there, which unfortunately does happen from time to time. And what I think is different here relative to private credit historically is that if that had happened 20 years ago, it would have been on 5 or 6 banks' balance sheets. And some of those big banks, those brand names that you know, would have taken several $100 million or $1 billion hits because of that. And it would have been really concentrated and would have created some major challenges. Now, it's less about actually reading the names on here, but we actually went through the bankruptcy documents for First Brands. And when you look at it, there's over 70 investors on there. There's some public credit managers, private credit managers. The point is that it is really diffused across the entire private credit landscape. And that means that the losses become really small for any one investor or one set of investors. So it can be absorbed in a way that it wouldn't have been historically. So we think that that's definitely a positive. We're less concerned that private credit is in a bubble. Now, that's not to say that private credit is perfect to the extent that you have exposure. This is not super insightful, but private credit is credit. It will go through a credit cycle at some point. That when there is a broader credit cycle, private credit will be exposed to that, and we will see those on the prior page, those defaults, we will see that tick up even further, and there will be losses as a result of that. We think the return that you're getting for being in a space like that is well compensated and worth continuing to take that risk. Okay, so I'll turn to the economy here and I'll move things along a little bit. I think one thing that has been lost here as the focus has shifted to everything happening in Iran and midterm elections and a new Fed chair is that we did have a major tax policy change in 2025, signed into law in 2025, but really the impact of that doesn't start hitting in a meaningful way to 2026. So this is another shock absorber for the U.S. economy that I think helps keep growth positive over the next several years. It was delayed for a year, but then very front loaded. So I think these are some of the things that lead us to a more constructive environment, even with all of the volatility and uncertainty right now. Another major thing that I think you're going to hear more and more about over the next few months is some major IPOs. So we have there's been a trend for a very long period of time, 15 plus years now, of private companies, private equity companies, venture companies that were very small when they started, being very successful, staying private for much longer. There's a few examples of that: SpaceX, OpenAI, and Claude, and Anthropic, the maker of Claude. So those are major players in AI. They are enormous in size now because of the success that they've had. And so they are likely to come public. It looks like SpaceX will be first. A few interesting things here. I think there will be a lot of interest in owning those names. So there will be a lot of demand for them. Because of their size, they are not going to be able to issue at the float levels that we usually see for an IPO. So usually when a company goes public, they issue about 15% of their stock out to the public, and then the amount that floats grows over time as insiders sell once they're out of lockup. Because of the size of these companies, I show 10% here. They're probably only going to be able to issue about 5% of their stock. Because if you look at the size of these three companies at 10%, it dwarfs total IPO proceeds. So usually you see an IPO and the actual issuance is 5 billion, 10 billion, maybe 15 billion. They're looking at 50, 75 billion. And then there's the index implications. All of the major indices are trying to change their rules to get these companies in there right away, so that because there's going to be so much demand for them, SpaceX at 1.5 trillion perhaps would become a top 10 name in the S&P 500 overnight if they just did it on market cap. So there'll be a lot of buying and selling that takes place around this that could have an impact on those Mag 7 names. And because of the lack of supply, we could see the values of these companies really run up. So I think that's something to really look out for, and something we'll be following closely in the coming months. Just a point here on inflation. We talked about rising inflation levels now, and this is just a comparison of essentially the 1970s, the late 60s going into the 70s, and the late teens for us into the 2020s now. And we got through that first wave of inflation that came through post-COVID environment when we had some supply chain challenges. The Fed had to tighten rates to normalize this, and it felt like we solved it. And now you see what happened. That was probably how they felt in 1975, 1976, only for another wave to come. And I think what you often see with long-term inflation is these multiple waves. And so you're seeing it a little bit now with the conflict in Iran bringing oil prices up. I hope that's not the catalyst to much higher inflation, because that becomes a really challenging economic environment and a really challenging investment environment. So something to keep in mind as a tail risk, and think about in your portfolios, how you potentially protect against that. And then looking a little bit longer term, I think one of the major themes that we see over the next 10 to 20 years that I haven't really talked about is just the high level of deficits and debt levels around the world, but in particular for the US. So this is historical government deficits for the US, and in lighter blue, how that trends over the next 10 years. And then what that means for debt for the US. So debt to GDP. How much debt have we issued in total relative to our total annual economic activity? And you can see when you're running 6+% deficits, you can't keep up with that with growth. Even nominal growth at 5%, you're outrunning that and growing your debt to GDP. And I think bringing that together here, I remember, post-financial crisis, there was always a feeling that, well, yes, we're issuing more debt than we should. We're running deficits, but hey, it's better to be in the US than anywhere else. It's a lot messier in Europe. You had the Eurozone crisis going on. Lots of China was deleveraging. And so there was a theme. I remember one of the phrases being that the US was the cleanest dirty shirt. And now we look at it, and on the vertical axis here, we have the deficit level, and on the horizontal axis, debt to GDP. And it gets a little scary here when you look at it and see the only country running a higher deficit level than the US is Brazil. And the only countries with higher debt to GDP are Italy and Japan. These are not exactly bastions of fiscal responsibility that we're comparing ourselves to here. And I think that's one of the reasons that you've seen something like gold run as much as it has over the last several years. And maybe there's potential for gold and other alternatives to the dollar to continue to run. So I don't think that that trend is necessarily done. So I think that's one of the major themes that we see over the next decade plus is just a weakening of global currencies and a strengthening of hard assets of all kinds. So something to keep in mind there. And then I think the other major theme that we see, I've mentioned AI a number of times. It's just this build out of AI. There's a major infrastructure build out that's happening. And then there's all the efficiency and productivity that comes with AI. And I just leave you with a couple examples here just to frame it. If you think over the last 100+ years, the build out of the electrical grid across the United States and across the world when electricity first became commonplace. One of the biggest infrastructure projects in human history, the build out of the freeway system. That was a 20+ year project. And then the broadband network build out in the late 90s. Now, there was a bubble there. There was a too much build out. There was fiber that stayed unused for years. And that's a risk here with this AI build out that too much is built. I think the demand is so high right now that there's very little risk of not of having too much. It's more likely the risk is that there's not enough. But I think this is going to have implications not just in AI and tech, but across the economy, and something to keep in mind as you think about your portfolios. So I think the big themes overall are AI. It's the weakening of global currencies, and then just staying focused on the long term. As much as the headlines every day focus us on what's happening today and yesterday, focusing 5, 10, 20 years out and staying committed to your portfolio is how you have success.